In fact, joining us to talk more about rates, this week's coming inflation data, and the impact of a less favorable outlook on U.S. debt from Moodys is former Kansas City Federal Reserve Bank President and CEO Esther George. Esther, let's just talk first of all about the message to the markets from Chairman Powell. Last week, we heard a slightly different message from Powell, maybe different emphasis on what he was saying. A lot of people have interpreted this as a more hawkish outlook than he had the week before. Do you see it that way?
Good morning, Becky. Yeah, I think the chairman was very clear. He has not signaled anything but a question mark about whether rates are sufficiently restrictive to achieve the FOMC's target of 2%. And so until that path becomes clearer, I think you will hear from policymakers that they are going to keep their options open.
Meaning that maybe the market got a little ahead of itself, thinking that, OK, that's the last rate hike, and we should be looking for cuts in the future, because that seems to be the market response from a couple weeks ago.
Right. I think there has been a lot of questions about the Fed has done a lot and how much more do they need to do. And so when a pause takes place like this one, it raises a lot of questions about whether this is the end or whether this is really just taking a breather as inflation data comes in and other aspects of the economy begin to signal to this committee where they should go next.
So if you were in the room at this point, if you were still kind of making decisions on what to do next, you'd be thinking what? And you'd be paying attention to the numbers this week, the inflation numbers this week, with a skeptical eye, with a cautious eye?
So I think if I were in the room this week, I would be happy to wait a bit longer. And that's because we are seeing signs of cooling in the economy. And I think the question will be, will those stall or will they reverse in some way? So again, looking at the inflation trends suggests that inflation has been working its way down slowly. But if the data that comes in and suggests otherwise, I think that's keeping the committee very alert to where it will need to go next. So a good time to watch. But I don't think you can be complacent just yet in terms of knowing that inflation's headed back to that 2% target.
Esther, just about every one of the market guests we've spoken with this morning, especially those watching the bond market, are already looking for when the cuts come. Somebody this morning said it could come as early as March of next year. Everybody seems to be of the opinion that rates are going to be a lot lower come 2025. Would you agree with that? You think that's a safe bet?
So I think when you watch the cooling that we're seeing so far, one might expect that we're not going to see another third quarter GDP number the way we have. And that although the consumer has been quite resilient throughout this period, there are signs, for example, when we look at credit and look at delinquencies, that things are beginning to turn. So I do think that as we look into 2024, it will, of course, be a question of when. I don't see it happening early in 2024, but certainly as we get into the year, assuming these trends continue, it is going to be time for the Fed to begin to think about its stance of policy relative to that cooling economy.
Okay, that confirms what we've been hearing from people. What did you think about Moody's move, where they announced that the outlook, they're lowering their outlook for the U.S. credit?
I think this is a very, very important and critical issue for our country right now. Our fiscal situation is not sustainable. And so however these rating agencies pin their marks on the U.S. economy, I think what is clear is that we're not on a good path, and action will be required if we are going to bring the fiscal situation back into one that allows the economy to continue to grow over time, that does not put at risk many of the important supports that the federal government provides to our economy. So it's a critical issue. And I think these ratings are just beginning to confirm what we've known for some time.